In 2023, the International Monetary Fund published a report describing Japan's public debt as the highest in the world among advanced economies. That sentence appeared in paragraph 47 of a 90-page document, and it generated almost no coverage. Japan's debt-to-GDP ratio has been the highest in the developed world for more than a decade. It has been called a crisis in waiting for 20 years, and for 20 years, nothing has happened. That is the story everyone tells, and it is technically accurate. What it leaves out is the mechanism. Japan did not escape the consequences of 255% debt to GDP through financial genius. It escaped through a specific set of institutional arrangements that are now, quietly and structurally, coming apart, not because of a policy failure, because of a policy success. The Bank of Japan spent 30 years suppressing interest rates to keep the debt serviceable. It worked. And now that it is working less, the structures built on the assumption that it would work forever are beginning to show stress fractures. There are 7 things sitting inside Japan's national debt. Most of them are invisible in normal times. Only one needs to break to make the others visible. And the one that is already moving is not the one most analysts are watching. The first thing is the number itself, 255% of GDP. For context, Greece, the country that triggered a European sovereign debt crisis in 2010 and required 3 consecutive international bailouts, peaked at approximately 180%. Japan is more leveraged than Greece at its worst by a significant margin and has been for years. The United States sits at approximately 123%, the United Kingdom at approximately 100%. The reason this number has not produced a Greek-style crisis is not that the debt is sustainable in the conventional sense. It is that almost all of it is domestically held. Approximately 90% of Japanese government bonds are owned by Japanese institutions: the Bank of Japan, domestic banks, pension funds, life insurance companies, and postal savings accounts. A government cannot be forced into default by foreign creditors if it has almost none. And a population that holds its own government's debt denominated in a currency its central bank can print has a fundamentally different risk profile than a small economy borrowing in euros it cannot create. That is the first thing. The debt is enormous. The ownership structure is what has made it survivable, and the ownership structure is the thing that is quietly changing. The second thing is who actually bought all of it. Between 2013 and 2023, the Bank of Japan purchased Japanese government bonds at a scale that has no historical precedent. At the program's peak, the central bank was buying bonds faster than the government was issuing them. By early 2024, the Bank of Japan held approximately 53% of the entire outstanding stock of Japanese government bonds. The central bank became the market for its own government's debt. This arrangement has a specific name in policy circles: quantitative easing taken to its structural limit, and it created a specific problem. In a normal bond market, if a government issues too much debt, bond prices fall and yields rise, effectively punishing the borrower with higher interest costs. Japan removed that feedback mechanism by having its central bank absorb the supply. There was no market discipline because there was almost no market. The Bank of Japan was both the issuer's largest customer and the institution responsible for setting interest rates. The consequence is that Japan's fiscal policy and monetary policy became structurally fused. The government could borrow without constraint because the central bank removed the cost signal. The central bank could suppress yields because it owned the market. This worked as a system. It works less well when the central bank needs to raise rates for unrelated reasons, and in 2022, it did. The third thing is what 30 years of near zero rates built inside the global financial system. Japan's interest rates were effectively zero from 1999 onward, with brief and failed attempts to raise them in 2006 and 2007. For 3 decades, institutional investors in Japan, the United States, Europe, and every emerging market between them could borrow in yen at near zero cost, convert those yen into a higher yielding currency, and invest the proceeds in assets with a positive return. That trade is called the yen carry trade. The gross outstanding position, estimated by the Bank for International Settlements and by various private desks, reached between $4 and $6 trillion at its peak. That number represents borrowed yen sitting in U.S. Treasury bonds, Australian government debt, Indonesian currency instruments, technology equity positions, and a range of other assets selected specifically because they earned more than the near zero cost of the yen borrowing. The trade works when the yen stays cheap. It works less well when the Bank of Japan raises rates. Because higher Japanese rates make the yen more attractive, the yen strengthens, and the cost of repaying the yen-denominated loan in local currency terms rises. At that point, every institutional investor running a carry position faces the same calculation at the same time. They often make the same decision at the same time. The fourth thing is what August 2024 showed us about that decision. On July 31st, 2024, the Bank of Japan raised its policy rate by 15 basis points, a small move by any conventional standard. The yen had been trading near 160 yen to the dollar, a multi-decade low. The rate hike, combined with signals that further hikes were coming, triggered a yen appreciation that unwound a portion of the carry trade. Within 4 trading sessions, Japan's major stock index fell approximately 12%. That was the largest single-week decline since 1987. Global equity markets fell in sympathy. Volatility indices in the United States spiked to levels not seen outside of the 2008 financial crisis and the 2020 pandemic crash. The Bank of Japan reversed course within weeks, issuing calming signals and slowing its rate trajectory. Markets recovered. Most analysts described the episode as a brief dislocation. That interpretation is available to you if you read it in isolation. Read it as a diagnostic, and it tells a different story. It shows that a 15 basis point rate move in Japan, a single 0.25%, was sufficient to trigger a global risk-off event. The carry trade was so large and so sensitive to yen movements that even a marginal normalization of Japanese monetary policy transmitted across every asset class simultaneously. That is not a market anomaly, that is a structural exposure. The fifth thing is what lives inside Japan's life insurance sector. Japan's major life insurance companies collectively manage approximately $3 trillion in assets. For 30 years, while domestic bond yields were near zero, these institutions were legally required to generate returns sufficient to meet their policyholder obligations. They could not do that by holding Japanese government bonds at 0%. So they moved abroad. Japanese life insurers became among the largest foreign holders of United States Treasury bonds, French government debt, Australian sovereign bonds, and a range of European corporate credit instruments. The logic was straightforward. Foreign bonds paid more than domestic bonds. Currency risk was managed through hedging programs, imperfectly and at cost. As long as domestic rates stayed near zero, the calculus held. When domestic rates rise, as they are doing now, domestic Japanese government bonds begin to offer a positive real return for the first time in a generation. At that point, the relative attractiveness of repatriating capital to domestic instruments increases. Japanese life insurers moving foreign holdings home means selling United States treasuries, French bonds, and Australian debt into a global market that does not necessarily have a buyer ready at the current price. The transmission is slow. It is also structural. I spent a significant amount of time on their disclosed portfolio filings, researching this video, and the rotation has already begun, quietly, in the data. The sixth thing is the interest payment arithmetic. Japan's current interest expenditure on its national debt runs at approximately 27 trillion yen annually. That is already the largest single line item in the Japanese government budget, consuming roughly 24% of total tax revenues. At near zero interest rates, this was manageable. The question is what happens to that number as rates normalize. A rough calculation. Japan's outstanding debt stock is approximately 1,300 trillion yen. Each 1% rise in the average interest rate on that stock adds approximately 13 trillion yen in annual interest cost. Japan's total annual tax revenues are approximately 72 trillion yen. A 3% normalization, still below what most developed countries consider a neutral policy rate, would add approximately 39 trillion yen in annual interest costs. That would consume more than half of Japan's entire tax revenue just to service existing debt. The money for everything else, healthcare, defense, and social security in the world's oldest major population would have to be borrowed, which adds to the debt, which increases the interest cost further. This is not a projection of what will happen. It is the arithmetic of what must be navigated. The Bank of Japan knows this. It is precisely why The rate normalization is being conducted in the smallest possible increments over the longest possible timeline, but the timeline is not indefinitely elastic. The seventh thing is where this ends up. Japan is not going to default. The Bank of Japan can, in the limit, purchase every government bond in existence and hold yields at any level it chooses. The mechanism for preventing a conventional sovereign default is intact. What is not intact is the idea that this arrangement is cost-free. The cost of financial repression, of suppressing rates below the level the market would set, is inflation, and over time, structural misallocation. Japan experienced the inflation dimension in 2022 and 2023 when global commodity prices transmitted into import costs in a way that 30 years of deflation had trained the economy not to absorb. The Bank of Japan raised rates in response. The yen carry trade began to unwind. The life insurer repatriation calculus shifted, and August 2024 provided a preview of what the unwind looks like when it accelerates even slightly. The position Japan is in is not one of imminent collapse. It is one of extremely constrained choice. Every degree of monetary normalization exports financial stress to the global carry trade and import cost pressure to domestic consumers simultaneously. Every year of delay adds to a debt stock that requires higher revenues or lower expenditure to stabilize. The window for managing this gradually is still open. It is not open indefinitely, and the global financial system, which has priced Japanese rates as permanently near zero for a generation, has not yet fully updated that assumption. I spent several weeks working through the Bank of Japan's own quarterly reports, the Bank for International Settlements, cross-border lending data, and the life insurer disclosure filings to build this. The numbers cited here are in those documents. They are not contested. What is contested is whether the timeline is short enough to matter to anyone watching this now. I think it is, not because Japan is about to collapse, but because the structures built on the assumption of permanent Japanese zero rates are embedded in every major financial market on Earth. When those structures reprice, not if but when, the repricing will not stay in Tokyo. If you have been following this channel, you know we covered the commodity choke points in the Strait of Hormuz and the financial architecture of Dubai's capital displacement using the same forensic frame. Japan is that methodology applied to a different balance sheet. The mechanisms are different. The logic is identical. Follow the money and follow it all the way to where it lands. If this kind of analysis is useful to you, subscribe. We publish new forensic breakdowns every week. Until next time.